Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, we've got some news this morning, but I am having data issues. So, well, it seems like NinjaTrader is fine. No, they're having issues too. Does that mean I'm just going to have to shut everything down? I don't know. What should I do here? I'm just going to shut everything down and restart it. All right, well, we're getting the numbers there. So, well, continued jobless claims 1.974. U.S. non-farm payrolls better than expected, 119 versus 51K. And the unemployment rate ticked up 4.4 versus 4.3. So that actually is kind of what I was expecting. I don't know. I should write all this stuff down or something, but I was saying I think that September was probably a little bit better than everybody says. And October's a little bit worse. Hold on, let me come over here while I'm logging into everything. So, I don't know what the market is doing yet. I'm kind of wondering, will the market really care about these numbers, or are they just kind of shrug them off? And we kind of get a big problem because they're never going to release the October data, and we're not going to get the November one until after the Fed meeting. So I don't know what you do with that. Well, my news squawk is saying that they are increasing the chances of cuts, but that it's still below 50%. Okay, Ninja seems to have connected. Here's Treasuries. Oh, okay, so we're at 24 still? Interesting. Rally in the Treasuries. My chart does not show. It must not have all of the data loaded here. Hold on. Because what I see is a rally this morning and then like maybe a tick up since the data release. So I don't know if I can really call that a rally. Oh, okay. It was just that chart is not loading it. Now we see that they did spike up. That's coming down. You know, I would expect them to probably have a really hard retracement on this. Yeah, the headline was better than expected, but the unemployment rate ticked up. Like, So what is the real unemployment rate right now, though? I bet it's actually probably like 4.5 or 4.6. I was going through some of the data last night, and I was still very frustrated because the data just does not reflect the reality on the ground, And because like when I was going through it, granted, I was kind of using ChatGPT to try and like find the numbers and then look at the websites and everything. It was estimating that like, oh, there's like 100,000 people in the tech industry that are out of work, and I'm just like, how is that possible? Because when you go onto Reddit, or you go into anywhere where there are people talking about tech careers, it is like a bloodbath out there. It's just crazy. And then they're saying, well, that's actually only a few 100,000 people. What? Okay. I don't know. They're actually already kind of going up. But we, like looking at the volatility, I think it's gonna be hard for them. Hey, maybe they've got a little bit of room. I think it's gonna be really hard for them to gain and retain 113 even. Just based on like volatility. And when I look at the volume, like we definitely moved, but there was not that much of an imbalance in the flow that came through. There's not really, so I'm not really yet seeing signs of something that could really have legs. And I do kind of think that a lot of the market will just kind of yawn at this because it's such old data, I don't know what's going on with the data. Maybe it's only a tech job market recession because of the AI job apocalypse. Well, I do think that is part of what's going on, Rox. But the point that I was making is, okay, every day, this is what bothers me the most, okay, is every day that I go on Reddit or anywhere else and see people talking about this, and everybody has their own stupid opinion about why the job market sucks so much. Oh, it's because companies are being too picky. It's because applicants are putting in too many applications and applying for jobs that they're not qualified for. Yada, 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 yada. And I'm just like, no, guys, why are you making this so complicated? This is very, very simple. There are more people looking for jobs than there are actually jobs available. It's that simple. And when in that situation, certain portion of the people looking for a job are not going to find one. It's that simple. It's that simple. Okay, so what actually is that imbalance? Because we know from the top line numbers that the number of people looking for jobs right now, like when you go into the survey, the household survey, people that are looking for a job is higher than the total number of job openings in the United States right now. But tech has been hit particularly bad. So shouldn't it be like way worse in tech? Is it like if you take the number of openings in tech and then take 30% of those out to account for ghost jobs, and then what is the imbalance? What is like that ratio? And with the data that I was looking at, one, we don't get very good data about it on a sector by sector basis. But then when we did those calculations, it wasn't that bad. And I'm like, what? And so I think that ultimately the bigger thing, of course, what I just said is true to some extent. But I think ultimately the bigger thing is that the reason that the conditions are that way is that companies have stopped hiring. And there's been so much going on, right? We had the rate cut, like the economy was kind of starting to struggle before the election. So we had that rate cut before the election. And then we had, it kind of got a little bit better before we get hit by tariffs in March. And then we went through that whole mess during the summer. By the end of the summer, it seems like most of the tariff stuff is kind of stabilized. We haven't gotten like a full deal with China, but it also seems like that's kind of on pause until after the midterms. And then we got the government shutdown, and it seems like the government shutdown has had a pretty significantly negative effect on the economy as well. So I think that there's a good chance that here during the holidays, we continue to see a lot of layoffs, and in January and February, and then start to see things recover. And if it really is that way, then when they recover, it'll probably recover really hard. The companies will be very quickly being like, well, we've been really strapped down for a while, and we really need to fix these things, and they're going to be really desperate to hire people. So the labor market could recover very, very quickly. But it could also be a more systemic issue, right? Or well, let's not say a more systemic issue, but just a bigger issue, right? It could be that the interest rates are still just too high to really grow or make anything happen in the tech sector. I'm very concerned about that. I think that we should be better. Like we got enough of a rate cut, and I don't know if it's really the absolute level as much as it is the changes. And since we did cut interest rates, it should get better there, right? It could be that they're not hiring because of AI, and we need AI to collapse before they start hiring people again. That's a scary one. I really don't think that AI is going to take everybody's jobs, but there's a lot of people that do, and you could have enough people that do that are in positions of power to cause a problem, you know? And then what do we do? And meanwhile, for the people that are out on the labor market, is just like limbo, you know? So yeah. That's where we're at. Well, let's watch it here for a second. I want to finish eating my muffin here. Or is it a muffin? A bran muffin. Well, speaking of which, I'm just browsing around here, and it sounds like Verizon is going to be laying off 13,000 people. So, like, that's where the numbers really start to not make sense to me. There's like ChatGPT using the data, and like I think it all made sense, but I think that it's just wrong. Was saying like, 1 to 200,000 tech workers, and I'm like, I think that there was like 100,000 people laid off just this month. Are you kidding me? So I think that the non-farms jobs report components that we just got are from September, but the unemployment claims I think is up to date, actually. Well, let's read from Zero Hedge, shall we? Finally, the spice is flowing again. Initial jobless claims dropped back near 2025 lows, 220K, which was below expected. However, while initial claims remained solid, continuing claims drifted higher to 1.974 million Americans, the highest level since October 2021. Likely thanks to the shutdown, we note that initial jobless claims for the deep tri-state fell significantly. Interesting. Now that Washington is back to work, we suspect those workers will be getting more pink slips once again. Finally, it appears jobless claims data is shrugging off the layoff announcements that have surged in recent weeks. Who do you believe? I think that you're going to see October numbers are going to be really bad, but we're never going to get the October number. We're never going to get the October number. And we're not going to get the November number until after the Fed meeting. Probably the November and maybe even December numbers might still be kind of bad too. But when that happens, the argument is going to be, well, you know, there was a shutdown and all this, right? So this is kind of where I'm frustrated, is that, like, I feel like we're not really going to have a really good idea of what's going on and whether the job market is going to recover now, or if we have to hunker down for the long haul until March. Continuing claims plays into the thesis that the job market is frozen. Yes. Yes. Well, shall we call it like, let's see here. What would be the best one of these to use here? I guess I'm just going to open up a new one. Okay. Option one is actually everything is fine. Option two is job market is frozen by economic uncertainty, tariffs, and shutdown. Right? Three is the AI job apocalypse is here. Am I missing any options? Forgot my period at the end of my sentence here. Whenever I'm making things like this, I'm always thinking, you know, should I put 2 spaces or 1 after my period? But apparently, I'm dating myself if I put 2 spaces. Oh, it's option 4. Option 4 is the data is fake. Yes. But putting these things in order of, let's change these around. I don't need to write that one down. We don't save this. I think the most likely one is the job market is frozen by economic uncertainty. You can read on your phone screen. Sorry. So then, oh, do I have a big one? I do. There we go. Okay. So in this one, once we go into each of these scenarios, then we can kind of game things out. Okay, so scenario 1 is that is just frozen by economic uncertainty. Oh, you know what? Let's add another one in here. To interest rates are just too high. Right? So in this one, we would say scenario 1 is market recovers in 2026. And the scenario 2 is it's too much and we fall into recession. Right? Interest rates are just too high. Scenario 1 is rate cuts were enough. Scenario 2 is rate cuts weren't enough and they find out in January. Right? Okay, on this one, I think there's only one option. If everything is fine, then job market, continuing jobless claims start to decline. Right? Same with the jobocalypse. One we fall into recession and AI bubble collapses. I don't like calling it a bubble, but whatever. Or 2, economy enters hypergrowth and everyone loses their job. One, 2, 4, and 5 all at once. Can we? Well, let's not use numbers for these ones. Let's change this. This is scenario A, scenario B. The data is fake, then that one scenario is we're already in a recession. Right. So it seems to me that the market seems to think that the most likely scenario right now is scenario 1A is what will happen. That it's economic uncertainty, and that when the economic uncertainty passes, then the market will recover. I guess we could add another scenario, C. More economic uncertainty comes, pushing recovery back. What could C be? I think that scenario 1C is not very likely, because it seems to me that Donald Trump is a little bit panicked about the midterms. You know what? It's kind of funny to me, because I've still been operating under the assumption that Congress is just not going to do anything. Congress is just not going to do anything. And if Democrats own the House, Congress still isn't going to do anything, right? Well, what they'll do is they'll investigate Donald Trump, and it'll be a big headache for him. But I don't know if anything will change. But he seems to have this idea in his head that, like, that's going to prevent them from doing anything, and we have to absolutely stop it and push through as much stuff as we can now. Should we come and take a look at our charts here? Make sure that we've got a good feel for where everything is at. So the S&P 500, they really, well, you know, there was a big jump in the beginning of the session, and then they slumped back down. And I think that this upside is almost entirely because of NVIDIA, right? I am not convinced that NVIDIA is as important as everybody is making it out to be. Like, I was seeing this stuff, Michael Burry was kind of mad about it. It's like, there's no way that their earnings are that good and blah, 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 yada, yada, yada. No, I totally think they are spending all of their money on GPUs. My concern is that NVIDIA is like the only one that's actually doing well. And the whole rest of the AI bubble is going to find out here really quick that there's a limit to how much debt they can take on. That's my concern. Okay, so here are the treasuries. Treasuries yesterday, ZN got a pretty big push down. Again, we keep getting this thing where it's like they buy, it buys up early on, and then as the session goes, they sell it. And I bet that we see that today as well. I would not surprise me to see us below 17 by the end of the day. I don't know if that's a trade that I could just straight up take here in this situation. Also, the spread is changing a lot here, so I have to keep an eye on that. Well, we can come back to that in a second. Okay, oil. Oil had a big drop the day before, but it's just kind of stabilizing now. Gold and silver. Well, there were some points where we were a little bit concerned about gold and silver, but they seem to be at least okay for now. There's copper. Copper's still kind of not really. Copper just looks like a real mess now to me, But that's the way that copper tends to look. So not, before where it was just like copper just kept trending up and up and up and up and it looked amazing. That's unusual. And then we got, okay, here's the Japanese yen. So there was a little bit of a bounce, but they are just getting pummeled. This also is a big problem, right? Like we could totally come back to our other scenarios and say like, actually what's going on is the job market is frozen by economic uncertainty. Oh, you know what? Actually, there more economic uncertainty comes. You know what these could be? This could be scenario I, which is there is some sort of a credit bubble. Credit crisis. Because we are seeing funding issues. There could be an AI bubble pop. I would be Japanese yen collapse. Causes equity sell-off. Man. When I start putting it in those terms, it's like, who are we? We are not anywhere close to, in the clear yet, are we? NVIDIA is important to its market weighting. They're too big to fall for the equity. Oh, yeah, totally. I don't understand why Michael Burry is expecting NVIDIA earnings to be bad. Like, come on. I at this point, I kind of wonder if NVIDIA like sandbags, like all of the data that they put out, they're intentionally sandbagging so that they can outperform the expectations on earnings every time. Because seriously, I have never seen a company blow out earnings. Like practically, I can only think that, like since this has been going on, so like what, the past 2 years? So like maybe the last 10 earnings that we've seen from NVIDIA, I think there's only been one where they like missed the expectation. And it's not just that they like beat every time. They just absolutely embarrass the analysts every time. So it's crazy to me that there's people, especially people as smart as Dr. Burry, thinking that NVIDIA, we're expecting NVIDIA earnings to be bad and collapse. And then when they're not bad, we're kind of arguing and in denial about it. That makes zero sense to me. It is absolutely, everybody wants GPUs, and they are basically taking all of the money that they should be putting into people, and they're putting it all into buying more chips. 100%. Now, where there's an issue, where I see an issue, because this really is, people have been saying, like Jerome Powell, he said in the last press conference, well, the AI bubble is different because, like, when you had the .com bubble, you had all of these companies that were really just concepts and did not have any real business or earnings there. Okay. And this is different because these are companies that do have a service that people are using. Is just that these companies are in the hyper growth phase, and so they're spending a lot of debt in the expectation that they're going to make a ton from it, right? So the issue that I see is that there is going to come a point where the market acknowledges, and I think it's already shifted. It's already shifted, but it hasn't turned into, like, a complete collapse, right? But they are realizing that these companies cannot just run the debt numbers that they're planning on. There's literally not enough money in the funding market to reach the targets, the amount of money that they want to raise. So is it that you go and you raise and then you're going to come short of your targets, and so they just kind of change all of their projections and the market just kind of readjusts? So you never get like a bubble pop per se? Maybe. Financial engineering, it's likely, but as Buffett puts it, it's only when the tide goes out that you see who's swimming naked. Well, but I feel like that the tide is already out. Tide is out, and they're all walking on stilts, so you can't actually see if they're naked or not. and you're all just kind of hoping that they're gonna lose their balance so that everybody can see them naked. Yes, those. Did you see? I made a TikTok where I gave the analogy of, like, you're driving around in a car with a GPS attached to you and trying to predict where the GPS is going to be just from the GPS coordinates. How hard would that be? But then what if you knew that they were driving to the store, right? And I made that on TikTok, and because part of it was, I think I want to use that in a video. So, like, how does TikTok react? But, like, TikTok is just not very good at me or for me as a sounding board anymore. But I thought it was kind of a clever analogy. And I kind of thought that the analogy of the water coming out, but everybody's walking on stilts now, was kind of clever too. So here's another one. If I can totally shift the subject. The other TikTok video that I made was basically, like, there's the retail day trader education pipeline. Shall we just continue editing this document and I give you the pipeline? Let's see here. Right, /work notes daily 20. Oh, actually, it's not. That's not that. The retail day trading education pipeline. Like everybody thinks that the different styles of trading and everything, that they're all like different schools. But I actually say that they're all just part of a pipeline. There's a pipeline that goes technical analysis, price action, order flow. And most people only know about the first two. And there's a smaller percentage that are coming over into order flow right now. It's getting bigger, but most people are only aware of the first three. And then I would say that the next step is market microstructure, which is to say how the very rules of the game lead to certain mathematical consequences that affect outcomes and optimal strategies. And you go into market microstructure because you start to question the setups that you've been given in order flow. Like you'll see why the data that you get from order flow is valuable, but you'll question if the trends or the setups that people are giving you are actually true. And what you're going to find is that most of the things that they are giving you are nonsense. But with market microstructure, you'll get, there's a couple of niche instances where the order flow can tell you something and it can be very, very useful. But then the kind of big takeaway from the market microstructure is that the market is more statistically efficient than it is informationally efficient. So then you come back up here and you go to news trading, which is really before technical analysis, right? It shouldn't like the pipeline be first you do fundamentals and then that doesn't work, and so you do technicals. But most people skip the news trading, which is unfortunate because the news trading is probably the one that requires the most time to learn. Takes years of you watching the market to understand that one. Right? Okay. And then you come back down and there is complexity economics. That basically sometimes the way that these outcomes happen don't necessarily make sense. And once you look into complexity and you realize that all of these interactions together can result in an emergent behavior that you would never expect. And that's why a lot of your predictions don't work. It's because you have to understand the emergent behavior rather than trying to use your logic to say if A, then B, yada, 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 right? But somebody else came in and commented on that thread and immediately threw a wrench into the whole thing. Because they said, what about gamma? Right? That actually is a good point. Like there's a school of day traders that are just entirely focused on options and the gamma. And we kind of we don't pay attention to that one as much as we probably should because we're not trading options. But the options absolutely affect the equity indexes. They absolutely affect the outright futures. And there's a lot to learn there just in volatility in general. So where would you put that? I don't think that fits as a sub item under any of these other six. So I think that we have to put that in there. And let's say gamma and volatility and put it like here between technical analysis and price action. Or actually, no, not there. After price, or no, after order flow. There we go. But are there other schools of thought? Oh, there's the astrology type traders. But I would put that as another form of technical analysis. So. Well, what do you guys think? Can you think of another school of day trading strategies that I'm not thinking of? I mean, that's under here goes the SMC. I think you overestimate people's ability. Well, yeah, like there's the whole thing is that there's a pipeline, and most people never get past point 2 because it's not in their face, essentially. You know, there's this idea that I've always kind of been interested in, and I don't think that I've ever really dove super deep into it because, like, I don't know what you would do with it. But it is the whole concept of mainstream versus underground. Like, the best example is music. There is the music that the big media conglomerates want you to listen to, that they're the most invested in, and they're pushing out to you. Taylor Swift, probably the most top line commercialized name out there now at this point, right? They want you to listen to Taylor Swift because that's where they make their money. And Taylor Swift made a lot of money. And there's a whole other world of music, particularly in electronic dance music, to some extent. There is a lot of commercial electronic dance music, but they have kind of created their own scene. Part of it was because the United States didn't latch onto it in the same way that Europe did. But that has kind of led to this completely separate ecosystem of music artists, labels, etc. in electronic dance music that we call the underground. And I guess you could say there's even within electronic dance music, there's the commercial side and there's the underground side, right? Especially when you get into like the clubs in Berlin, right? They play weird stuff over there. They play really weird stuff over there. There's the mainstream and there's the underground. And it seems like that this is a pattern that exists in like all human social systems for some reason. That here in the retail trading education world, there is the mainstream, the stuff that gets pushed out to you on TikTok and Reddit, which is essentially technical analysis and price action. And order flow maybe kind of comes in there a little bit, but those guys aren't as big because it's more money and not as many people want to buy it. And all of these other things like volatility to some extent, yes, but then definitely market microstructure, complexity, economics. You know, news trading is there because the professionals definitely pay attention to that. But in the retail trading, I have not found a community where there's a lot of doing what we're doing, where it's basically we spend all day arguing about the data and what it might mean for our day trading, right? It's underground. It's underground. But I kind of wonder, the thing that had me thinking about this yesterday was, I think it was Scott Calloway. I can't remember, but somebody on TikTok was talking about like as soon as a boy becomes like abandoned or feels abandoned by their male role model, like the father leaves the home, their chance of being incarcerated is higher than their chance of going to university. That it's like just like the instant that happens, the all of the outcomes for you change. And what's with that? And I think that it is the same thing, that it is, there's the mainstream and there's the underground. The underground is basically there to get away from the mainstream. And to some extent, the underground is there to undermine the mainstream. And I think that this is like a survival mechanism in humans. Do you realize that you are not in the dominant party, and so you resort to underground methods? That there's always going to be like this opposing faction, and that's where there's going to be a lot of like youth gangs, organized crime, these sorts of things. It's like something that almost naturally will always come about in a human system. When you put it in those kind of terms, maybe some of the way that we feel about the industry make a little bit more sense. Is that what we're really experiencing is being in the underground and being frustrated that our subversive campaign is not having any impact, you know? And that just makes you want to tear the whole system down, right? Because that's what happens, is the underground becomes big enough, then they tear the system down. So the whole thing is, for the mainstream, is to keep enough people included in the mainstream that you don't get pulled under by the underground. So this is just kind of thoughts. That's why it's like, okay. That's an interesting line of thought. I don't like have any empirical evidence for it or anything like that. But even if it's true, what do you do with that? I don't know what you do with that. Okay, let's read here Zero Hedge's story about the payrolls. In our preview of today's jobs report, we showed that the range of estimates is extremely broad, from 105K on the upper end to negative 20K on the lower end. And I will note, just because I always pay extra attention to Goldman Sachs, I think that they are really good at this especially on the payrolls, and their estimate was 80K. We said that if today's jobs number is atrocious, the Fed would once again be viewed as being behind the curve. So perhaps, working in conjunction with the newly returned BLS employees, the outgoing Fed chair snuck in a pointer or two, and in an attempt to avert allegations of blowing up the economy, moments ago the BLS reported that the delayed September number came in stronger than all estimates at 119K jobs. Okay, so they are on 0.4 still, but the data is all fake. But I thought that September was better than people thought. Like it really felt to me like things were starting to recover in September, and then the government shutdown happened and just killed everything. So October's probably really ugly. And will we get recovery in November, December? It might take longer than that. It might not be until next year. Okay. Which, however, followed yet another downward revision as the total non-farm payroll employment for July was revised down by 7,000 from 79,000 to 72,000, and the change for August was revised down by 26,000 from 22,000 to negative 4,000. Okay, so much for Goldman's thesis that August would be replaced sharply higher. Interesting. With these revisions, employment in July and August combined is 33,000 lower than previously reported and continues the trend of relentless downward revisions. Manufacturing jobs also fell for the 6th straight month. After August's surge in part-time jobs declined in full-time, September flipped the script with a surge in full-time jobs as part-time jobs tumbled. But the U.S. unemployment rate jumped to 4.4% in September, its highest in 4 years, led by Black unemployment. The participation rate rose for the second month in a row, but earnings growth slowed in September. Okay, so the participation rate rising like that is a little bit concerning to me, because that says to me that, well, I wouldn't expect, like, a lot of the low participation rate is people are spending longer in school, right? So that's probably not going to change. So if it changed significantly, that might be people's spouses starting to work, right? Basically, my wife is working more, and so the labor participation rate goes up. All right. Earnings growth slowed in September. Rate cut odds are higher following the jump in the unemployment rates. Now, what will Fed speak do now? Yeah, this is a good question. There are still Fed speakers, isn't there? Do we have any today? Fed's cook speaks at 9. Also, we got Kansas City Fed manufacturing. So I guess another thing we can talk about is I tried doing a little bit of AI assisted coding here with anti-gravity. I should close that now. Don't need to open. And did pretty good. Did pretty good on our GUI. I've got all that code refactored out, which I was a little concerned about. Like, that was going to take me a while. I think it would have taken me a day or two, just because, you know, I keep going like, well, I don't know what's the best way to, like, organize all this code and stuff. Anyways, and then I had it, like, do the beginning of, like, drawing. So it draws two squares now. So, like, as though like a chart. So that means that the GUI is ready for data, I think. It's ready for data. So I guess I'm going to go and check data providers again, but probably we should really start with a free end-of-day data provider, right? And then I tried sticking it on our volatility model. And let me tell you what, like, the suggestions that it gave me were terrible. They were terrible. And it basically wanted to get rid of everything about how it worked that was good. It basically wanted to completely change the volatility model and change it into VWAP Bollinger Bands. It's like, no. No thanks. So, that was really interesting. Yeah, ew. I do wonder, because one of the issues that I got here is like, the bands are based on where the start was. And doesn't it make sense that if you get a jump like that, that the bands should now be, that you'll like get a jump like that, but then volatility will consolidate. And so you should just have a new set of bands around that jump. So where would you do that? What's you would have to use some sort of volume based smooth moving average, I guess. I don't know. And then how would all of the work on variance and everything work from there? It just doesn't completely, I don't understand how you would do that. And almost surely there is some professional work out there on this point, right? But for some reason, Google Gemini is terrible at picking it up. Versus ChatGPT was giving lots of good suggestions for it. So what's with that? That's kind of weird. But I don't know if I'm going to do too much on I think we're going to let the volatility model do its own thing for a while. And I want to make sure that I have a video on December. So today I'm going to really, really focus on writing that video. What else do we got going on? Oh, you know what? I should check here. For some reason, Bitcoin came to mind. Now, Bitcoin has had a pretty brutal decline. And it was like late last night, getting worse, but it looks like they've recovered for now. You know, when I look at it on this longer term chart, like, sure, that's a big decline, but it's not terrible. Like, it's really just coming back to where we were at the beginning of the year. This was mostly like the Trump rally. You know, the rally on the ETFs and everything, that was going way back to here, right? So it's not until we get back to like the 50K levels, for instance. This whole one, like late 2023, that jump is really actually quite insane when you think about it. So, I don't know, when I look at that chart, I kind of think, oh, that's probably okay for Bitcoin. I would really like to see it collapse and have a strategy really have to pay for what they're doing and everything. But it may just be that strategy kind of gets stuck underwater and screwed. But, well, I mean, if really, it would have to be that they would be liquidated. So, I don't know, man. I don't know. Doesn't seem like crazy to me yet. Oh, wow. There's somebody on CS Kerr questions. I am done posting here. I got an offer after 8 months being laid off. I am moving on with my life. The offer is at Coinbase. Years of experience for base 179,000. I wonder where that is, though. I had seen some job postings by Coinbase, and initially I ignored them. And then I was like, well, I nothing else is working. I'm gonna try that one. And they ignored me. But then I see other stuff, like some of the things that the Coinbase CEO has been saying and everything, and that has me like, you know what though? I really don't want to work for Coinbase. I really don't want to work for Coinbase. From r/advice animals, if you're about to get taken down by the release of the Epstein files, go ahead and snitch on Trump. It could catch. It's really crazy to me that these people really think that there's still think that something's going to happen from that. I guess there's like a whole month, right? Like it is going to get released, but it's going to take them a month. Ooh, hey, is the Treasury's going to bust the high? Now wait, why would that be? For only the first minute of the S&P, they seem to be on the upturn. They are above 67.25 too. So we'll be keep an eye on potential. Like yesterday, there was a lot of systemic selling. Today, I think you got to be careful about systemic buying. But it's really weird that the treasuries are lining up back to their highs at the same time that the E-mini is starting a rally there. So the negative equity correlation is not there today. I guess another thing I would say is that my market order imbalance is kind of suggesting that this move in the treasuries is getting a little too much. Andre says I use Cloud Opus for programming. Yeah, the thing that surprised me about using Gemini and anti-gravity, because I've used Claude for a lot of things, but there's been a lot of kind of certain tasks that it just seems absolutely terrible at. Like if I ask it to write, if you ask Claude to write Python code, it's perfect. Or to write JavaScript code, it's like you get exactly what you want. And they will tend to like give you something way better than what you asked for too, which is really interesting. Is it when I was using it in my contract job, I felt like it really helped me level up because, it would say, oh, well, why don't we include this? And I'd be like, well, what is that? And then it would teach me all about it. And I'd be like, oh, okay, cool. Like, sometimes I would go slower because I was really analyzing like every little architecture decision we could there to its full extent. And so we got really good quality work in the end. But Gemini does not do that. So I was surprised by Gemini because it was giving me Rust code that worked. I wasn't doing as complicated of a thing as what I've done to get the Rust GUI to where it is now, but it did the tasks that I did in one shot. And none of the LLMs have ever given me working Rust code. So that was curious. I wonder if maybe part of it is just that Gemini has been better trained on Rust. And perhaps because Gemini is a newer model, it is picking up the more recent frameworks that I have to use in Rust as well. That could be another factor. But there's definitely something different about Gemini that seems very like almost surgical, because one of the things that I'm seeing people discuss is, well, if you look at all of the benchmarks, Gemini is just absolutely destroying some of the benchmarks. Like they're doing significantly better than the other models, especially on the tests that the models have been struggling with the most. But then you go on social media and everybody's talking about how terrible it is and how can Google produce such terrible stuff? And that just doesn't line up with my experience. So I think the reason that they're saying that is because Gemini is maybe trained towards different languages, different tools, and also it may just be kind of like their use case. Like Gemini is probably not as good for vibe coding. You tell it, make me a really cool website that's purple and yada, yada, yada. I don't know if Gemini would do as good of a job at that. Gemini has prompt problems? I don't know. Like, one thing I did like also was it will do anything that you ask it for, it will make a plan and ask you before it does it, which is something that when I vibe coded with Claude was always kind of a problem, is it would just immediately start going down this road and you had to stop it. And with Gemini, I like almost never have to stop it. So I think that it is that people have kind of built tools and workflows and everything that are all optimized towards Claude, and so they just don't carry over to Gemini. And I think that Gemini seems to be geared more towards a business use case. Like, it's anticipating that the people that will be using it are already experienced programmers, which is not really the case for Claude. I think Claude really seems to be marketed towards people that have no clue what's going on. It's like, hey, this will allow you to program. Okay, by the way, we did bust the highs. I'm actually... All right, fine. I don't want to do this, but I think it's worth a shot here. Okay, so that's not getting filled. There is about a 20K change in delta going up on this, so I probably don't want to fade that. Let's see here. On Google, almost everything is proprietary. It will also try to sell you products versus help you simply make something. Oh, really? Differences in the way that it's trained, for sure. Okay, here's an interesting thread on Reddit. Changed my view. Profit sharing by companies should be mandatory. Because, like, the whole thing I see here is it's all about allocation of capital. And it does seem that capital has become more valuable than labor lately. And one of the ways that you could maybe fix some of these problems is to align incentives and everything and give employees more of a share in the ownership. And this person says it should be mandatory, which I'm kind of like, well, like forcing a certain structure and so forth, I'm a little bit weary of. Why am I getting... Oh, because I have to. Never mind. Should probably on this other volatility number get rid of the tag. Well, let's see what but most people don't even get that far. So it's interesting that somebody's posting a thread like this on Reddit, because I think it's one of the most important things for us to be discussing right now. I've been discussing means to address wealth concentration. Among the ways to address it, I considered wealth tax, which might be a more direct measure, but I also considered means that would not use the government as an intermediary to redistribute gains. Profit sharing is when a company scores profit in a given quarter, a portion of the profits would be distributed to its employees. Primary purpose is to prevent a situation in which the owners of the company, or more commonly shareholders, give bonuses or massive dividends to themselves, much at the expense of the company and its employees. To reduce the short-termism that exists on the market, and in particular with publicly traded companies, to reduce situations in which the common employee struggles to get by while executives flourish in the millions, this incentivizes situations where the company regular employees are cut as savings to be distributed to the top. Address rampant wealth inequality. Wow. The issue I see is that in situations where there is profit sharing, it was not such a crazy amount that it would fix any of those things. And oftentimes the profit sharing comes at the expense of something else, right? Like instead of getting yearly bonuses, you get profit sharing. That's what happens. As a ballpark figure, let's assume a 10% profit share per quarter paid out to all employees, which means everyone from shareholders to interns, outsourced employees, and part-timers included, based off of current profit applicable to all companies paid in cash. It's a starting point to be adjusted. It could very well be negligible for startups, lower for smaller companies, and higher for larger companies to not harm the companies just starting off while reducing the dominance of the bigger players. The exact profit definition of profit may vary, but I'm open to the one least likely to be judged by clever accounting. Tentatively, I think the best would be cash flow from operations, which reflects actual cash generated by the business in a period. Potential strength of the solution is tying worker compensation to shareholder compensation. Shareholders always mean to be paid more, so it can be used to help employees. The French implementation of mandatory profit sharing is something I had in mind, but expanded upon and encompassing all companies and using a simplified metric. I admit the potential flaw of the solution are attempts to shift profit to not count within the definition, or shift payables receivables to minimize the obligation. Legally, the solution should be classified as a separate category of compensation to not cause a wage substitution or a top-down tipping, so to speak. The figure cannot be too high to discourage investment, or nor too low to not be impactful. If a company has no profit in a given quarter, no profit share is paid out, but if there is, it must be paid. The profit can be spread out over the year's next quarter to smooth out the process, avoid the morale volatility, and reduce manipulation. What would change my mind? Providing alternative, better means to address the burgeoning power of shareholders relative to the company's workers, as well as the sheer amount of speculation. Conceiving examples showing mandatory profit sharing fails to achieve these goals does not have my intended effect. Evidence that this system could be net negative by harming employees or economic performance, hitting the bottom line of everyday people, or other mechanisms to achieve redistribution more effectively. Let's ask. I had not heard that France has mandatory profit sharing. The first thing in when reading that is I really what you want them to have is more ownership of the company, and that doesn't happen if you're just paying them cash. And so because it's just cash, it will probably just substitute that as part of your salary, for instance. There's solid recent empirical work on France showing mandatory profit sharing does transfer corporate profits to workers and disproportionately to lower skill employees within profitable firms, but it doesn't look like a silver bullet for reducing economy-wide income inequality or for broadly giving workers equity ownership of firms. It's mainly a redistributive/bonus savings mechanism, often tax advantaged, not widespread worker share ownership. well. So the spot where I kind of thought like, it's gotten a little bit overdone here, but then I thought better of it because we were coming after a pretty big meta order. Well, it's just been frozen there. So we'll give it an hour, see if they make another move. But I think that the market is reading that unemployment rate edging up, despite the numbers being really good. The what do they call it? It's not that. There's the household survey and there's the business survey, I guess. The household survey showing unemployment edging up, despite the business survey showing impressive job beat. That I think is concerning to the market. What if it was like, if your company is over a certain size, you have to be incorporated with shares of some form, and for all compensation, you give employees the choice of what percentage of that will be in salary and what percentage of that will be in ownership shares of the company. That might be interesting. Probably the issue that you get into where you say, we are obligated to give employees shares is like, that totally works for Nvidia because they're growing like crazy and all of the employees are millionaires. But for a company that, like, they're doing okay, they're making money, but they're not growing, you know, then giving the employees a share of the company every year would just dilutes the original investors' share of the company every year. And so that would significantly disincentivize people to put up capital for startups and things like that. So I think that could be a problem. Well, it looks like the E-mini wants to take another step here. It's interesting to me the way that they've like, yeah, okay, well, NVIDIA is good, but then we also have to wait for the non-farms. Now that the non-farms is out, even though I think it was bad and they're saying rate cuts are more likely, but maybe the market just likes that rate cuts are more likely. So they could be rallying because of that. But at the same time, I'm looking at the deltas and I'm seeing an extremely powerful divergence here. Like, I don't think I've ever seen a divergence like that. I'm gonna post that in Discord. What's that about? And the yield curve did steepen. Did steepen. So I think that is kind of in line with our scenario. But this insane divergence in ES, I find that disconcerting. Like, there's nothing about a divergence that tells me, oh, well, then that means that the move's not real, or it's likely to reverse, or that there could be something wrong with the economy, or anything like that. It just means that the order flow in the equity index is not what's driving the rise right now. And that makes perfect sense. Like, well, not that it makes perfect sense. What am I trying to say? Like, that can happen all the time, and it doesn't necessarily have to be a big deal, right? But I just can't imagine why it would be happening in this situation. In this situation, shouldn't it be that we've had a big decline? We had a lot of systematic selling come in. We easily recovered it. The systematic sellers should be buying back. Shouldn't there be strong market buy volume coming in as well? That doesn't line up. So something's off. There's something is going on with this move that is unusual, and I don't understand. Okay, here's something interesting to me. So I've noticed a rise in a type of job called a forward deployed engineer, which sounds like potentially a good job for me, except for not if it involves flying, because, well, maybe it would be okay. Wife stay home. But saw a post a while back asking about forward deployed engineering jobs. It's the new buzzword lately, so I decided to analyze a bunch of forward deploy engineer postings to see what is going on. Forward deploy engineer jobs are up 1,165% in 2025 according to Bloomberry, so you should rebrand yourself as one and apply to all of these jobs, right? The elephant in the room is that around 40% of these engineering roles are just rebranded sales positions. Yes, well, they're not rebranded. So, you know, the funny thing is that this is basically what my father did. This is basically what my father did, and it's funny that they have basically invented a name for it now. Because he was a sales guy, but he basically became the sales guy that was there every step of the way through the adoption of the product to ensure that it was adopted effectively, and that they would then continue to get business out of it, right? Because they were doing self-checkout registers, and like how you structure your store and everything makes a big difference as to whether or not you get what you invested from it. That's why when Walmart did it, it just was absolutely terrible, because it just increased shrink, because they didn't change the format of their store at all to deal with the self-checkout. So that doesn't surprise me. Companies are just slapping the FDE title on sales engineering work because it sounds cooler and attracts better candidates. How can you tell if it's fake? Look for quota, OTE, or commission structure. That's sales, not engineering. Check if the role represents sales to GTM instead of engineering. If responsibilities focus on demos and deal closure rather than production deployments, or you hand things off after the contract signs, it's not real FDE work. In short, read the job description. Don't just base everything off the job time. It killed me how Dollar General all overinvested into self-checkout, then turned almost all of them off due to the yeah. Well, so there was this whole thing. I tell you what, man, when there's like an issue just kind of pops up out of nowhere and suddenly you see it everywhere in media, you got to be suspicious. It's a psyop. It was totally a psyop, and now you don't hear anybody talk about it. But there was a few companies that they had kind of always put off investing into self-checkout and did it and adopted it in the worst way possible. So I remember my dad talking about this and saying like, well, they did this deal with Walmart, but the way that Walmart is adopting it, it's going to be a disaster. And it was, And so then there was like this whole psyop to trash self-checkout. When it was like, no, all of the companies like Home Depot has been using self-checkout forever and they love it. Those companies aren't going to give it up. By the way, well, I thought I recentered this, but maybe I didn't. Well, now that things have stabilized, I'm curious. We got a whole hour to see. I'm curious to see if the treasuries have another push or not. Yeah. That thread was not as interesting as I was hoping it would be. Japanese Prime Minister decided to unveil a fresh stimulus package worth $120 billion, which is 3% of GDP. In Japan, inflation has been above the central bank target for 2.5 years, and the Shunto wage negotiations have now produced 5% salary bumps for 2 years in a row. Yet the Bank of Japan still sets rates as low as 0.5%, and the government is now working on a gigantic fiscal stimulus package on top. As a result, bond investors extrapolate a future full of inflation risks and macro volatility, and they want to be paid more to hold the long-dated government bonds. Yen sellers were right, yeah. Well, so the picture that he posts, though, is pretty wild. This is going back and showing the bond yield going back, and it really is like parabolic. It is. that can't go on forever, right? This is very quickly going to cause chaos elsewhere. And I'm going to bet that before it's all said and done, that there is quote unquote intervention. You know, there will be intervention of some sort. We'll see. But I wonder if that intervention will be that bonus, that stimulus gets shut down in a way similar to the way that the tax cuts got shot down in the UK. I tell you what, every once in a while, I will get stuff on TikTok about what's going on in the UK, and I'm constantly like, whoa, holy crap, there's like all sorts of wild, crazy stuff going on in the UK that we never hear about. Like apparently Sadiq Khan's political career is on the rocks right now after he canceled some meeting that was to honor veterans, and the king didn't like that and overrode him. And then there were leaks that basically the reason that Sadiq Khan wanted to cancel the event was because it would only be celebrating, you know, white World War II veterans. And so Sadiq Khan's like popularity is plummeted and all this crazy stuff like that. And I'm sitting here like, how did I not? Why am I hearing about this on TikTok? What? News sources that I follow aren't talking about that. It's disconcerting. Venture capital. In a nutshell, mildly rich people ask really rich people for money to give to mildly broke people. Hope that someday mildly broke people become really rich people so they can give more money to the mildly rich people so they can keep the cycle going forever. It is exactly what the startup world is. Well, that's what it seems like to me. You know, I don't think that I know nearly enough about the startup world as I wish, I guess. Ooh, what's this? Igor Halperin has a new book. A Practitioner's Guide for Investment Management, Reinforcement Learning, and Inverse Reinforcement Learning. The monograph is available here for free. What's that? A comprehensive scholarly work focused on a single topic written by one author. Unlike edited volumes with chapters by various authors, a monograph provides an in-depth... Oh, okay. So you get the whole book. The whole book, AI and Asset Management, Tools, Applications, and Frontiers. Suffer that it's not just by one person. There's multiple authors and an editor here. What? Let's hear. 1, 2. Oh, hey, it's got Francesco A. Favosi. Igor help. I recognize any of these other names? No, I don't. They're all interesting, though. Probably all people I should look up, perhaps. Is there contents? Yes, there is. Okay. Unsupervised learning. Overview of technique. Network theory. Support vector machines. Ensemble learning and investment. Deep learning. Reinforcement learning and... Well, that's... I'm gonna save this. Put it in my stash. Stuff that I, like, never read. Love it, Igor. Love it. Ukraine under pressure as reports. Amid reports, Russia and the U.S. have devised a secret peace plan. And I don't think it's like that. Like, Trump was pressuring him for all. Uh-oh. Jim Esposito, president of Citadel Securities. Citadel Securities is expanding into high-touch equities. And I'm really thirsty. I'm gonna get some water. Wow. You know, I haven't been paying attention to the equities as much, but there was quite a quick drop there in ES, wasn't there? I think they're recovering it, but that's a little interesting. Rock says NQ's just chopping around. Give it a little, let them cook. I mean, I tell you what, well, I don't think that there's enough time today and tomorrow, but let's just say for the sake of argument, if we ended up below that 67.25 by the end of the week, or even worse, like back towards the lows by the end of this week, even after the NVIDIA earnings, that would be such a bad warning sign, you know? You blow out earnings that much and they're still selling, that's a big problem. That's a big problem. But I kind of think that what we're likely to see is a market that's a little bit more choppy, but still ultimately to the upside as we get like an end of year rally come in. Crack says he agrees, yeah. But I mean, there's definitely been a sentiment shift in the market, and I think that you're going to continue to see that in the market for probably the next year or two. Like they're not just gonna ignore that and it goes away. My gut feels like it's a recession crash landing, but the data does not agree. Well, you know, there are definitely pieces of data though that are very concerning, right? It's not like that all of the data disagrees. It's just the headline numbers, right? And I can see how, when we analyze it all, that scenario 1 seems the most likely, that the job market has just been frozen by economic uncertainty. Like that could explain, that could explain the things that we're seeing. So I got to maintain bullish bias, but it's not easy holding longs. You know what though? So you know what I've been doing, in like at least in my equity portfolio. I haven't looked at it in a while. Maybe I should look at it today. Is that I have some things that are kind of high beta, and then I just hold more cash, or I'm holding it in bonds. So that seems to be working really well for me right now. If something does happen, I'm holding the bonds and I probably won't get hurt too bad. Granted, it depends on which of those higher beta longs that you hold. Well, mine are more banks and less AI, so... feel like I need to long equities. Well, if I wasn't between jobs, I would absolutely be putting more money in and putting it into some stocks, because there's some stocks that I really wanted to put in on and I missed out. I feel like I have to short NVIDIA and long the market to keep the AI trade out. Well, you heard that there were some hedge funds that were doing that they found out that they were so exposed to the data center build out that's happening right now that they shorted NVIDIA to hedge themselves. And they're probably feeling it right now, right? The AA trade is the market, yeah. I don't know. I'm honestly I'm really skeptical of the AI trade, but I'm also skeptical of it completely collapsing. Like I think that there's a good point that like this isn't like the .com bubble. There's probably going to be a repricing, but I don't think that repricing is going to be like a complete collapse of the market. Altman wasn't a good look. Well, because they have made these commitments, right? I don't even know if it's so much about revenue to back up the commitments. Like at this point, it's entirely reasonable to say we should invest this much in order to meet the expected market need, even though it's not anywhere close to that yet, right? The problem is there is not enough capital available to get to that. So you're putting up a growth projection that you will not achieve unless the government gets involved. Right? So does that mean that the whole company has to collapse? Well, there's certainly a possibility, but it would have to be in something that I don't understand. But just given that information that we just went over there, that doesn't mean that the company has to collapse. It just means that they will need to reprice it. Now, Treasuries did eventually come down a tick or two. Should note that the shorter end of the curve seems to be getting hit harder. So maybe the curve is flattening back out. Why are data centers built in Virginia instead of a super cold city? Probably because the infrastructure doesn't exist there. Where is a really good super cold city? Like, should they be building stuff in Manitoba? Or the Northwest Territories? Let's just start building data centers in Alaska. That would make sense. Or Greenland. There you go. Right in the middle of everything. No. Everyone is celebrating the NVIDIA saving the SPY again, but nobody is talking about the bomb that dropped yesterday. BlackRock is waiving management fees on private credit CLO because performance is so toxic they're afraid of an investor revolt. Absolutely. Going back to this. More economic concern, scenario 1CI. A credit crisis of some sort. And there is definitely some warning signs for it. Like we're straight up seeing companies go under. Private credit companies go under. And by the way, who's going to pay for all this AI data center spend? Well, how about private credit? Oh, okay, except for that the private credit scene is like a complete disaster right now. It's too complex. Yeah, it really is. No, you're right. Like, well, it's... man, this one in particular really puts us at the epistemic limits. This is a concept that I don't talk about maybe as much as I should. But epistemic limits basically means that there are certain limits to what we can even know. That, you know, in particular, there's just like no data. You have some sort of a system that's running, but you can't go in and investigate the data inside of the system without destroying the system. So how do you study it? And that's exactly something that could be going on here, is that there is all sorts of problems in the credit markets, and we're not going to know about them until they materialize. But we do have strong reason to believe that there are problems because some companies recently went kaput. They ought to be put front and center. Well, so I think that people started to get a little bit nervous like a week or two ago. But that was kind of like, well, repo rates are doing this because it's like the end of the quarter. But the issue is that the quarter has come and gone, and they haven't come completely back, as far as my understanding. So, you know, and we were waiting for all of this stuff. So I'm going to bet that there's a greater focus on that stuff in the next few weeks. That, you know, we had some bigger things. We're kind of past those. What left is there to talk about? What's going on in private credit, probably. From r/day trading, how Alex Hormozy accidentally fixed my trading brain. I'm not even gonna read that. Being early is the same thing as being wrong? Maybe. By the way, I should know the S&P 500 did overcome that like temporary decline, but Bitcoin has not picked up. Bitcoin is a good speculative barometer. Yeah. Well, I think that there's something else going on there too, though, because on the downturn, we definitely saw something where like Bitcoin went first. Bitcoin went first. So, I'm not sure if it's all just speculation. Now they're decoupling a little bit. But does Bitcoin continue to be pressured? I don't know. Like the thing with Bitcoin is that I still ultimately believe that it is manipulated. I think that Tether prints money. They will take $100,000 from somebody and print $200,000 of Tether. So I don't think that it's even remotely all backed. And if anything happens, if there's too big of a decline, them and Michael Saylor start taking on credit to buy Bitcoin back up with it. So that kind of makes it hard for the doomsday scenario in Bitcoin to happen. But right now, I kind of have to wonder, like, what is driving the decline? Is it just speculation? No, I don't think so. Like something has changed. And something's changed with strategy too, because their premium has gotten completely destroyed and they're having a trouble now raising money. So I don't know what's changed, but is the question, has it changed enough for a big downside scenario to occur? Maybe. Do you mean on the upside? Well, yeah, but it's not moving up right now, so I don't know. I guess the thing is that if it was just speculation, I would expect them to be buying. But I don't think that what we have right now is speculation. I think what we have right now is Nvidia earnings were good, and so you are going to see buying, and then that buying puts the systematic strategies back into buy mode. And so that's why you're continuing to see upside. And those forces are not going to create buying in Bitcoin, hence Bitcoin's not coming with it. Now, Bitcoin outright selling a little bit here, that's, I don't know what that's about, but that's maybe a little bit more concerning. Michael Burry says Nvidia spent 112 billion on buybacks. Really? That's crazy. Well, we're back to 14.5, which is a little bit more reasonable of a range. And you have to keep an eye on the treasuries, because I think that we still need to look out for the they just sell it all day thing, you know? So I'm seeing in the ChatGPT subreddit, LLMs now think they are more rational than humans. So they use advanced game theory, but only when they think they're competing against other LLMs. Oh, they're getting there on r/jobs. the delayed September report shows the economy added 119,000 jobs. And our slash jobs says, so are they just lying? The government lying? Well, I never. No, I think that those numbers are probably legit. Yeah, who knows what the it'll be funny. It'll be funny as like the revisions. Like, how are they going to do revisions when we get the November report? Are they going to come in and do the revisions and say, okay, here was the September number, and we didn't have the October report, but this is what we would have revised it down by in the October report, and then here's the second revision? Or will they just only have the second revision? Maybe they'll only have the second revision. But like, what if the second revision came in and it was like, actually it's 0, you know? Like, just because the report that we got is delayed, like my understanding is the way that they did it is they were preparing their report. They probably had a week's worth of work to get the report ready before the shutdown happened. Then they stopped. So then when things ramped back up again, they completed compiling their data. So that does not mean that this particular report will be more accurate than the other ones in terms of the revisions. By the way, I should note, you know, we had an interesting spot where based on our volatility projections, you know, there was like 2 spots, and the extended session, it held to the tick, but it was really, it rotated around where our new model said. So this is kind of weird. So this brings me back to this thing where it's like, okay, you think that there's only 200,000 jobless people looking for jobs in the tech sector specifically, but like there's 200,000 people on, you know, filing new claims every month or every week period. Like, there was this EU guy that said when it gets perilous, you have to lie. Yeah. I mean, I really think that things are set up in a way that you wouldn't want to lie too bad, right? Like, I think that one of the things that has happened is the way that they do certain things in the jobs report, like the way that they estimate new businesses being created and destroyed is like way big off. And they've probably done some things that kind of intentionally make it so the revisions are bigger, but not where like you can just outright lie, because the market would pick up on it. I think that what the market has picked up on so far just kind of exposes poor methodology and not lying. Yeah. Some people, yeah. So here's another thing, is that when Biden was in charge and we were getting these numbers, we were questioning it every month, right? I continued to question it, but a lot of those people kind of stopped saying anything when it was Trump. And now I'm starting to see people on the Democrat side question the numbers. We have so here's somebody on Reddit. We have record layoffs right now, record high delinquencies in auto, private credit, and student loans. Americans are increasingly falling behind on their utility bills. This is going to tank the economy because Trump, as narcissist and cheap, and his merry band of sycophants are incapable of looking in the mirror and adjusting based on what they see. They are not in reality. But then, like, the whole thing here is this is saying that the data is fake. So really what he's saying is he thinks that the Trump administration is lying about the jobs numbers now. I'm really disappointed that we will not be getting a November data point before the next Fed meeting. Well, everybody in the r/jobs subreddit thinks that they're lying. We should run a pool on what the revision will be when we finally get the November number. Because if this number, we had a blowout number and it was 119, and then it gets revised down like 100,000 or something like that. Like these other ones, the revisions in that report were more milder and not a huge deal. Okay. But if that one ended up being a big revision, man, I really feel like that at that point, like, would that finally be the point where like all hell breaks loose and people stop believing the numbers and everything? Because come on. That would just be so crazy if they revise that down 100,000. You'd be like punching a hole. I don't know. Well, I would never destroy my screen, but I would be pretty pissed. Yeah. Like, oh man, you have a Federal Reserve meeting. Like really, think about everything that we've had, right? Okay, we had a shutdown just before we got the news. We waited forever. We didn't get any news. Then we finally get the number, and it's way above expectations. And then we don't get another number until after the Fed meeting. The Federal Reserve decides to not change anything with interest rates because they don't have the data and everything looks fine. And then after that, a week or two after that, I don't know how much of a time it is, they revise the last number that we got down. And then maybe November number is bad. And the Federal Reserve just left interest rates where they were when they should have cut. Oh, yeah. I would be pissed. I think that there would be revolts. Like, So far, it's just like the analysts and the people trying to predict this number complaining about it, right? But the point at which it causes an obvious Federal Reserve policy mistake, that's a lot of very influential people that will have lost a lot of money. Ooh, we're gonna move up again, huh? Well, it's time for me to get going. I don't think what we're seeing right here is another leg to the meta order, but let's see, you know. The end of the day, you think that they could get to 113 even still? It could happen. I don't know. Ooh, the E-mini is tanking. Wait, what is going on? Did I miss something? E-mini is tanking hard. Below the open now. Granted, there's still a long ways to go to retrace all of this morning's actions, so... okay, U.S. Fed's Cook. U.S. financial system is resilient. He sees an increased likelihood of outside asset price declines, though she says not a risk to the financial system. In other words, she thinks that that AI is in a bubble. It has hedge fund trading strategies in treasuries, a potential risk to market liquidity. Generative artificial intelligence use in trading raises concerns, could have benefits, but must watch it carefully. Doesn't see private credit posing a current threat to the financial stability, but it's worth keeping a close eye on it. That's it. So I think that move right there may have been a Fed's Cook. My news squawk hasn't been doing a very good job of keeping us up to date on that, but you can watch live resilience and vulnerabilities in the financial system. Wells Fargo says Fed should cut in December. Wells Fargo's Sarah House says the Fed should cut rates by 25 basis points in December, citing easing inflation and growing labor market slack. She notes hawks may argue against the cut due to above-target inflation and solid job growth, but the bank is still sticking with its call while acknowledging it's a close decision. Note that they're not predicting that they will cut, just that they should cut. Oh man, you know what? Like if we, okay, if this scenario that I was just drawing out, where the Fed doesn't cut in December, and then we get the November jobs data, and it's really bad. I also think that really could be enough for Donald Trump to pull the trigger on one of these crazy plans to oust Jerome Powell. That could also happen. Not to scare you, JP, but well, so with that, maybe they could get it to 113 even. But I'm not going to stick around. I have a bunch of jobs I've found to apply to. I haven't really applied to many this week, but I think I got 6 today, so I'm going to get up to that. I will see you guys tomorrow. Stay excellent.